Welcome to BT Podcasts. In this episode, find out what futuristic technology is reimagining finance and reshaping tomorrow's markets. This podcast is produced in collaboration with HSBC.
The quantum future, it's closer than you think, and it's going to shake up finance big time. Come along as we dive into how HSBC, who's really leading the pack in quantum tech for finance, is tackling the super exciting and a bit wild new world. We'll chat about everything from keeping data safe from quantum attacks to making complex financial models work even better. We'll also dig into the smart quantum leaps of faith they're taking and why working together is key to getting this tech everywhere. Welcome to BT Podcasts by the Business Times. I'm Howie Lim, and joining us is Philip Intallura, Global Head of Quantum Technologies at HSBC. Philip, thanks for your time.
Thanks very much for the invitation. Great to be here.
So it's sounding a bit beam me up, Scotty, if you will. What types of quantum safe solutions are being explored today?
Well, when we talk about being quantum safe, what we really mean is modernizing our cryptography so it can resist future quantum attacks. Now, quantum computers can't yet break today's encryption, but the technology is advancing and regulators and cyber agencies are all warning banks to begin the transition now, especially for public key cryptography, which is the cryptography that has the main vulnerability. So at HSBC, we've been focusing on three areas. First is post-quantum cryptography. So these are brand new algorithms, entirely classical, no quantum involved. And they're designed using different branches of mathematics that are thought to be resistant to quantum computing. And NIST in the US, NIST is the National Institute of Standards and Technology, they have already standardized the first set of these new algorithms. And in most cases, they'll replace RSA and elliptic curve cryptography that underpin security today. Second is quantum key distribution. This is a complementary approach that actually uses the laws of quantum physics to distribute key material. And the beauty of QKD is that it gives information theoretic security. So it doesn't matter how powerful a computer becomes, the protection comes from physics itself. Now, it's not unconditionally secure. Nothing is, because it requires physical implementation and trusted nodes in some cases, but it does add an extra layer of defense for critical applications. And then the third is cryptographic inventory. Before you can upgrade, you need to know what you're upgrading. And so we're establishing the tools to scan our estate and identify exactly where different forms of cryptography are in use today. And that's the essential first step in any quantum safe transition program. So those are three pillars: post-quantum algorithms, QKD for defense in depth, and cryptographic inventory. These form the backbone of how we're preparing for a quantum safe future.
Obviously, with quantum, the optimization of it can help to boost portfolio management. And we're also wondering, as a result, though, will quantum hedge funds emerge, or are quantum ethics guidelines something that are needed first?
Well, that's a really interesting question. And I think the short answer is yes, we will see quantum hedge funds, in my view, because anything that will give competitive advantage, you'll see some organizations look to capitalize on that. And it's probably unlikely that ethics guidelines will come first. And here's why. Portfolio optimization is one of those areas where quantum could really add value. You're effectively balancing thousands of assets, risks, and constraints, and classical methods, whilst powerful, start to hit limits. And what quantum algorithms might give managers are new ways to explore that space, potentially finding better balanced portfolios. Now, if you look at history, hedge funds don't wait for the regulator before trying new tech. We saw that with AI. Funds branded themselves as AI hedge funds long before AI actually delivered a clear advantage. And I think the same will happen with quantum. But that said, regulators will need to catch up. The big issues are access. If only a few firms can afford quantum time, does that create, an uneven playing field? And of course, there's systemic risk, like faster strategies amplifying market shocks. But those guidelines are more likely to evolve alongside adoption rather than ahead of it. And that's similar to how we see AI playing out today in terms of, large language models. So in short, it's likely that we'll see quantum hedge funds first, and then the ethics and guardrails will follow.
I imagine it's pretty costly to do. So, given those high costs, what's a realistic approach or realistic adoption path, say, for financial institutions?
Yeah, so look, when it comes to costs, there are two big challenges. Firstly, they are incredibly expensive to run. And second, we don't yet have a clear demonstration of quantum advantage for something commercially useful. And so that makes near term investment difficult to justify. And in most organizations, that's a real barrier because it presents an opportunity cost. But this has to be balanced against the potential upside because independent estimates put the potential value of quantum computing for financial services at around 600 billion US dollars over the next decade. And so ultimately, it's a risk versus reward play because banks that start investing now and building readiness will be best positioned to capture that value. And look, quantum is a steep learning curve. So waiting until the technology is mature effectively risks being left behind. Now, in practice, the adoption path is staged. So this also helps with this cost element because first you would stand up a small team and map the hard compute problems that quantum could eventually impact. That's exactly what we've done. Then you run pilots using cloud-based quantum access. So we're not buying a quantum computer, right? We're accessing them via cloud. And we're benchmarking against strong classical baselines and quantum-inspired methods. And so from there, you harden the winners with proper governance and model risk controls, and you only scale the use cases that demonstrably beat the alternatives. And so that makes this whole thing a lot more manageable. You don't go a fast scale approach right at the beginning.
And obviously, ecosystem collaboration plays a big part, right?
And the ecosystem collaboration is very, very important. And this is where it comes in because as an end user, we shouldn't shoulder this journey alone. So we do work with academia, startups, big tech, and regulators. And we often tap into government backed projects and grants as well. And so the work we're doing in Singapore is an example of that. And that shared effort lowers the burden on us, lets us, effectively experiment more widely and accelerates the readiness curve without overspending. And so collaboration is really the multiplier that makes this both affordable and bank grade. And that's how we can manage this without requiring hundreds of millions of dollars of investment.
Earlier, you talked about cybersecurity and such, and that how quantum machine learning can offer advantages for better fraud detection. Where do you see the benefits going, and how do you ensure, though, that the transparency is still there, accountability as the models evolve?
Well, look, fraud detection is one of my favorite use cases because it's a great example of where quantum machine learning could add value on a problem that we're all aware of and can easily understand the benefits of improving your precision in these models for detecting fraud. And so banks deal with huge complex data sets. There are millions of transactions with subtle patterns that can indicate fraud. And quantum models, in theory, could be better at spotting correlations in very high dimensional data. And that could mean fewer false positives, faster detection, or catching patterns of fraud that classical systems might miss. But with that potential comes responsibility because fraud decisions directly affect customers. They directly affect you and me. And so transparency and accountability are non-negotiable. At HSBC, we take a few steps. So, first, we always benchmark quantum models against the strongest classical alternatives. We don't get a free pass here when it comes to quantum. But second, we use explainability tools so that we and our regulators can understand why a model flags a transaction. And third, we build governance around the models, from independent validation to ethical review, just as we do for AI and models today. There's no difference. So the benefit could be sharper fraud detection, but the only way to get there is to balance innovation with trust. And, I'm very aware that quantum doesn't replace accountability. If anything, it raises the bar for it.
All that thought, Phil. Still to come, what about quantum leaps of faith and Singapore's role in the bank's quantum strategy? More with Philip Intallura from HSBC in a moment.
And now back to BT Podcasts in collaboration with HSBC.
Welcome back. Phil, let's talk about, say, the balance between innovation and regulation. Earlier we talked about it, and it sounded a little like regulations always playing catch up, if you will, in this quantum era especially. And since HSBC is one of the most recognized banks in the world for its work on quantum, you must have a strategy for this.
Yeah, it's always a balance. On the one hand, systemic institutions like banks have to be cautious. We're custodians of the financial system, and regulation exists to protect stability, customers, and trust. And on the other hand, if we wait for every regulatory detail to be finalized before we move, we'll miss the innovation curve and risk being left behind. In the quantum era, that means a dual track. We innovate in safe spaces. So these are things like sandboxes, pilots, collaborations with academia and startups, while staying tightly engaged with regulators. In fact, at HSBC, we've been working with regulators for several years on the topic of quantum through sharing knowledge, co-authoring white papers with the Financial Conduct Authority in the UK, for example. We co-present at conferences and even run experiments with the Monetary Authority of Singapore. So it's not innovation versus regulation, it's innovation with regulation. And for banks, the goal is to build readiness and prove value whilst ensuring that when the technology scales, it's done in a way that's trusted, transparent, and resilient.
Phil, talk to us about, say, early successes and failures, which shaped your strategy. What were your biggest sort of quantum leaps of faith?
I'd say our biggest quantum leap of faith was simply deciding to invest early, well before there was a clear business case or industry consensus. A few years ago, quantum was still seen as science fiction for finance. And in fact, some people still hold that view. And committing real budget and building a dedicated team was a risk, but we believed that waiting until quantum was mature would be too late. So, what shaped our strategy since then are the early successes and the lessons from failure. So, on the success side, we've run some world first experiments, for example, using quantum key distribution to secure an FX trade or testing quantum random numbers to improve financial models. And those prove that quantum can be made bank grade. We're also very well positioned on the defense side and are considered a thought leader in this space. If I wind back 3 years ago, it was literally me saying, trust me, I'm a doctor when it came to the quantum threats. But over the last 18 months, we've had new standards released. Regulators have issued advisories, and cryptographic agencies are all saying quite vocally that banks need to start to prepare to mitigate these threats. So that's paid off for us tremendously and driven a lot of secondary value for the organization. But we've also learned where not to spend time. Early algorithms that looked exciting in theory often collapsed under real-world data complexity. And that taught us to always benchmark against strong classical alternatives and to treat quantum as an option in a broader compute toolkit and not a silver bullet. So the leap of faith was starting early. The strategy that emerged is experiment widely, partner deeply, kill what doesn't work, and scale only the use cases that pass both the technical and commercial test. And that makes our quantum program very applied and disciplined with a bias towards commercialization, which is my ultimate goal when it comes to quantum computing.
Are you seeing any skills gaps, though? What's the skills landscape now with regard to quantum technologies? And will it change further, particularly in the field of finance, the new roles, the capabilities that are needed?
The skills landscape in finance is already shifting because of quantum. Now, today, banks don't suddenly need hundreds of quantum physicists, although we have a few, I'm one. But what they do need are translators, people who understand enough of the quantum space to map it onto real business problems and enough of the business context to guide where the technology could actually create value. So I see three main categories emerging. First, quantum aware technologists. So these are developers, data scientists, cyber specialists who can work with new toolkits like post quantum cryptography, hybrid classical workflows, etc. Second are business translators. So these are the quants, the risk managers and strategists who can identify the right use cases and benchmark them properly against strong classical methods. And third are the integration roles. And these are the professionals in governance, compliance, and operations who make sure these solutions are adopted in a safe and regulated way. At HSBC, we've already started preparing by building quantum literacy across our organization, not just in the research team. We run training programs for risk managers and business leaders, and we're embedding quantum awareness into our broader digital skills agenda. So the future isn't about replacing bankers with quantum scientists. It's about upskilling the existing workforce and creating new bridges between finance and deep tech. And that's how we'll be ready when quantum moves from the lab, and it's still a little bit in the lab at the moment, but as it moves from there into the real economy.
And HSBC recently launched Quantum Center of Excellence here in Singapore. Why Singapore? What sort of role will Singapore play?
Well, Singapore plays a really important role in our global quantum strategy. It's a hub where government, regulators, academia, and industry are all pulling in the same direction. And that makes it a perfect place to push the boundaries of this new technology. By launching our Quantum Center of Excellence there, we'll be able to tap into world-class research institutions, collaborate closely with the Monetary Authority of Singapore, and plug into the region's vibrant startup and innovation ecosystem. And to some extent, we're already doing that in the short time that we've established the hub there. It gives us a base to run experiments, to co-develop use cases and build skills in a region that's strategically important for HSBC. And so whilst our quantum program is global, Singapore, I think, is a place where we can accelerate to test technologies in a supportive environment, build talent pipelines, and contribute to shaping regional standards. It's not just about HSBC in Singapore. It's also about how the work we do there feeds into our readiness worldwide.
Earlier, you talked about the importance of collaboration. How else do you see these ecosystem partnerships with academia, like you mentioned, maybe regulators, startups as well, shaping the development of quantum finance?
Yeah, I mean, ecosystem partnerships are absolutely central to making quantum safe a reality in finance. No single bank can do this alone. The challenge is just too broad. With academia, we tap into cutting edge research and the next generation of talent. With startups, we get agility, new tools for cryptographic inventory, post quantum algorithms, or early quantum key distribution developments. With big tech, we rely on the cloud platforms and large scale infrastructure that banks simply can't build themselves. And with regulators, it's about trust and standards. But I think what's equally important is banks working together, because cryptography underpins how institutions communicate. And if one bank lags behind, it creates a vulnerability for the whole system. And that's why industry-wide collaboration is critical to share costs, to accelerate learning, and to ensure, the transition to quantum safe is consistent, interoperable, and trusted across the entire financial system. And that's the reason we've actively been trialing QKD with the Monetary Authority of Singapore and other banks in Singapore just in these last few months.
I wish we could speak more, Phil. Thank you so much for your insights today.
Thank you very much. Thank you for inviting me here. It's been a pleasure.
Philip Intallura, Global Head of Quantum Technologies at HSBC. This has been BT Podcast by the Business Times. I'm Howie Lim.
This episode of BT Podcast was produced in collaboration with HSBC.
Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.